Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. In this course, we focus very heavily on the concepts of what we call managerial accounting. Managerial accounting. This is very different from what you learned in Principles of Accounting 1. Principles of Accounting 1, we explored the concepts of creating and reading and analyzing the financial statements, income statement, balance sheet, statement of cash flows, statement of retained earnings. That's what we did in Principles of Accounting 1. We learned about those financial statements, how to create them, how to do journal entries, go through the accounting cycle, etc. The reason why you learned all those things in Principles of Accounting 1 is because it's important that you understand the building blocks of accounting. And we start with the accounting financial statements, which is what you learned in Principles of Accounting 1. You learned about the accounting cycle. In Principles of Accounting 2, we focus on what we call managerial accounting. Managerial accounting is how managers and other employees of a business use those financial statements that you learned about in Principles of Accounting 1, how they use them and analyze the information to make decisions. Okay. In managerial accounting, we look at internal information. What I mean by that is we look at financial statements that are created just for the employees and managers of the company to make decisions. That's the whole idea behind managerial accounting. And throughout this course, we're going to talk a lot about internal information of accounting for companies. Primarily, we'll be focusing on cost. We'll be focusing on internal cost to the company. And that's what managerial accounting is all about. So throughout the next 8 weeks, 7 weeks, I want you to please get into the mindset of a manufacturer. When we talk about manufacturing, we talk about creating a product. When we create a product, there are costs associated with making that product. Direct materials, direct labor, factory overhead, these are all costs that go into manufacturing a single product. And so throughout the next 7 weeks, I really want you to get into the mindset of manufacturing. What goes in to creating a product? And that's the mindset I want you to have throughout the next 7 weeks. So for right now, we're going to talk about managerial accounting, the differences between financial and managerial accounting, and then we'll jump into looking at financial statements for manufacturing companies and retail companies and service companies. That way you can understand the difference between those three types of companies. So managerial accounting, what is it? We focus on non-financial information for managers of an organization to make decisions. That's the nice, cute textbook definition. What we focus on when we talk about managerial accounting is internal financial and non-financial information. Internal. The word internal is so important. Managerial accounting focuses on the company internally. The type of financial and non-financial statements for managerial accounting is not made public. You'll never find a budget for a company on the internet. Okay, it's just not going to happen. Nobody publishes their budget. You don't want to give away your company's secrets, yeah? You'll never find cost information for a company on the internet. That's internal information, yeah? So managerial accounting, we focus on internal financial and non-financial information to help managers to make decisions. That's what we mean by managerial accounting, and that's what this course is going to focus on. So the reason why managers look at financial and non-financial information for the company is, of course, multifaceted. As a manager, I need to be able to plan for my company's success. I look at financial and non-financial information to develop new products, expand into new markets, build a new factory, purchase new equipment, hire new employees, grow the company, etc. I look at financial and non-financial information as a manager to do these things, to plan for future growth. So I put the plan into motion, right? I start doing these things, start growing the company, producing new products, going into new markets. When I do that, I monitor what's happening. Monitor what's happening. And after I monitor what's happening, I can then start to control things. Right? Once you put the plan in place, you see what's happening, the results, and then we start to put controls in place. I can control my costs, my direct labor, direct material, factory overhead. I can control those costs. I can control the profitability. I can control how happy my customers are. And once I control those things, by altering the plan a little bit, making decisions based off of what's happened after I implemented the plan, then I can provide some feedback to the plan and then go through the process again. We call this the managerial cycle. Yeah. This course, again, focuses on managerial accounting. We focus on the internal aspects of the business. Decision makers are the managers and employees within the organization that make decisions. That's my target focus of individuals, are the managers and employees that make decisions that are inside the company. Internal users are the people who look at managerial accounting. In Principles of Accounting 1, you learned all about financial accounting. Who are the users? Everyone, right? The external users, investors, creditors, the government, etc. In this course, we focus on the managers and the other employees that make decisions. In Principles of Accounting 1, that information helped, the financial information helped investors, creditors, the government, and the other people outside the company to make decisions. Principles of Accounting 2, which is this course, we look at the internal financial and non-financial information to help managers to make decisions and help them control their decisions. The reporting is different between financial and managerial accounting. Financial accounting, we published our income statement, balance sheet, statement of cash flow, statement of retained earnings, according to the generally accepted accounting principles. You all remember the principles, right? Matching principle. We had a couple of other ones, reporting principle, etc. That was financial accounting. But in managerial accounting, we don't have to have such rigor in our reporting. The reason for that is because in managerial accounting, I can customize my reports. So the managers can use that information the way they need to. Yeah. and they can access that information quickly. In financial accounting, we report our financial statements monthly, quarterly, semi-annual, annual. In managerial accounting, we report it when we need it. In financial accounting, we focus on the whole organization. In managerial accounting, we focus on process, procedures, and divisions. In financial accounting, we'll only focus on the monetary information that's on the income statement, balance sheet, statement of cash flow, statement of retained earnings. In managerial accounting, we focus on monetary, but also non-monetary information like customer satisfaction. So these are the differences between Principles of Accounting 1, which was financial accounting, and Principles of Accounting 2, which is managerial accounting. In all accounting, especially in managerial accounting, it's important that our companies are ethical and transparent. Ethics is so important in accounting because we deal with money. It's important that our information is reliable, that we're protecting our assets, like our inventory, we're upholding our company policies, and we're promoting efficient operations. These four things help to establish a system of internal controls that we use in the business in order to maintain a proper accounting system. In managerial accounting, there's a lot of different jobs that you can get in managerial accounting. Chief financial officer, a controller, division controller, general manager, financial analyst, senior accountant, staff accountant. You all know that I was a financial controller for quite a few years. I didn't make that kind of money. I wish I did. But yeah, I was a financial controller for some time. There's a lot of different career paths that you can find in managerial accounting. And remember, managerial accounting, we focus on the internal information in the company. So the jobs will be somewhat different than they would be for financial accountants. I had mentioned earlier that we focus a lot on cost in this course. The reason why we focus on cost in this course is because as managerial accountants, as managers of the company, we need to understand our cost so we can control our cost. By controlling costs, we can generate more profit, right? It's simple. If I keep my costs low and my revenue high, I can generate more profit. Yeah, absolutely. The reason why business exists is to generate profit. Yeah? That's how you stay in business, is to generate profit. You need to generate profit to stay in business. Very straightforward. So I'm going to show you cost and explain how cost can be managed. Costs can be classified in really two categories. We have what we call fixed cost and variable costs. They mean exactly what they mean. Okay. A fixed cost is a cost that does not change with the level of changes in activity. What I mean by that is these are costs that do not change regardless of what else is happening in the company. For example, If I'm a manufacturing company and I make calculators, okay? I make calculators. I manufacture calculators. My fixed costs stay the same regardless of the number of calculators I produce. If I made one calculator or a million calculators, my fixed costs remain the same. Can anyone on the call today give me an example of a fixed cost? What would be a cost that does not change regardless of the level of output? Any examples? What do y'all think?
Is it insurance?
Insurance, yes. Correct.
Like a utility bill or a loan.
Utilities change. So, like for example, like your electric bill is going to be different every month, right? It's based off of the level of consumption. So utilities would actually be a variable cost. I can see how you might think it's a fixed cost, but a fixed cost is a cost that does not change over time. Yeah, stays the same. So Tia, another way of thinking about this might be, I think you mentioned. Did I hear the word loan?
Yeah.
Yeah. So like if you took out a loan, you make the same monthly payment, right? Same amount. That would
Mm-hmm.
be an example of a fixed cost. Yeah. Good point. Yeah, fixed costs is ones that do not change over time. What else? What else we got? What about rent? Would rent be a fixed cost or a variable cost? What do you think?
It can change sometimes.
Sometimes, yeah, but
Variable cost. Because it changed each year.
right, but it's usually the same for at least 12 months, right?
Yeah.
Yeah.
So it's a fixed cost. Yep. Fixed costs are the costs that do not change for about 12 months, roughly. Uh, they're relatively the same, regardless of the level of output. Excellent. Very good. Yeah, so fixed costs do not change regardless of the level of activity. Another example would be salary. If you get paid a salary, you get paid the same amount regardless of how much you work, right? That's what salary means. So if you're a salary employee, you can work 40 hours, 30 hours, 60 hours. It doesn't matter. You get paid the same amount. You're on salary. See, that's why sometimes salary isn't that great, right? But salary employees, they can work more or less, doesn't matter. They're going to get paid the same amount. Hourly employees, that's variable cost because they get paid based off of the number of hours worked. So salary employees, that's a fixed cost. Hourly employees, that's a variable cost. Make sense?
Yes.
Awesome. Cool. Thank you. So again, fixed costs are costs that do not change over time. Uh, and they do not change with the level of activity. Examples would be rent, um, salaried employees, insurance, etc. Things that do not change with the level of output. Variable costs, these change with the level of activity. Examples of that would be utilities, hourly employees, um, raw materials. Let's think here. Um, maintenance cost. Um, these are things that change with the level of activity. The more that I make, the more cost is associated with it. That's what variable cost means. Okay. So if I'm in the process of manufacturing calculators, the more calculators I make, the more hourly wages I'm using, the more utilities I'm using, the more materials I'm using. These are all variable costs, yeah? Raw materials would be the plastic and the numbers and the electronic components. Those are all my raw materials to make a calculator. So raw
Okay.
materials, Go ahead.
I'm sorry.
What about a bank account?
Bank account? What about it?
For the variable cost?
So bank accounts, they're only concerned about having cash in them. So there's no cost associated with a bank account.
Oh, okay.
Good question. Good question. Yeah, so when we talk about cost, we're only talking about costs associated with doing business. And examples of that would be fixed costs and variable costs. Fixed costs are costs that do not change regardless of the level of activity. This would include things like salaries, which are part of wages, rent.
Dr. B,
Sorry?
Dr. B, could I try another one? What about like if something's on sale, the cost of clothing?
So clothing is a variable cost because it changes
Yeah.
with the use. Changes with use. You use the clothes, right? It's variable cost. Depends on how much you buy. Variable cost. So don't think about it like a household. Yeah, this is don't you gotta change your mindset. Think about like you're running a business, not like you're running your house. Those are very different things. So you want to get in the mindset like you're running a business. So fixed costs, costs that do not change with regardless of the level of activity. Salaries, rent, mortgage, uh, insurance, things that do not change. Yep. Variable costs, these change with the level of output. Raw materials, direct labor, these are hourly employees, direct labor. Sometimes factory overhead, it depends. We'll talk more about these things. But just understand that fixed costs don't change with the level of activity. Variable costs, these do change with the level of activity. When you hear me say level of activity, that means number of units that I'm producing, I'm making. There are direct costs and indirect costs. I need you to understand these two terms, and here's how I'm going to explain them. Direct costs are costs that I can directly trace to an object. Direct costs are costs that I can directly trace to an object. For example, raw materials. We call these direct materials. Raw materials are called direct materials. Reason? Make a calculator. Okay? My raw materials are plastic and electronic components. They're my raw materials. I can directly trace the cost of the plastic and electronic components to a single calculator. Therefore, direct materials, raw materials, are considered a direct cost because I can trace those costs directly to manufacturing a single product. Another example, I mentioned this earlier, is what we call direct labor. These are the hourly employees that manufacture the calculator. These are the people on the assembly line that are manufacturing the product. We call them direct labor. They are directly involved in the manufacturing process. When you hear the word direct labor, think employees that are directly involved in the manufacturing process. That's direct. So direct materials and direct labor. These are what we call direct costs. They are costs directly associated with the manufacturing of a product. I can trace these costs to the manufacturing of a product. Make sense? Direct costs. Yeah?
Yes.
Okay, excellent. Thank you. We also have what's called indirect costs. Indirect costs are costs that I cannot directly trace to the manufacturing of a product. Okay? This would include things like maintenance expenses. While yes, the maintenance employees clean the machines that make the calculators, I cannot directly trace the maintenance labor to the manufacturing process. Indirect costs also include things like utilities. In the manufacturing process, I have electric that go to the machines and to the lights, but I cannot directly trace that to a single calculator. Okay, it's indirect cost. Another example would be the supervisor's salary. The supervisor's salary, because the supervisor oversees all of the people in the factory, I cannot directly trace the supervisor's salary to the manufacturing of a calculator. Therefore, the supervisor's salary is an indirect cost. So, direct costs, I can trace those to the manufacturing process. Indirect costs, I cannot easily track to the manufacturing process. Are we clear on this? Okay.
Yeah.
Wonderful. Thank you. I'm going to keep saying these three terms a lot throughout the next 7 weeks. Direct materials, direct labor, and factory overhead. You're going to hear me say those three terms a lot. Okay, so I need you to understand what they are. Direct materials, again, are all the materials that go into making a product. Okay? For my calculator example, my direct materials to make this calculator are plastic and electronic components. These are my two direct materials to make a calculator, plastic and electronic components. Direct materials. Direct labor. Direct labor are the employees that are responsible for making the product. These are your hourly employees on the assembly line. These are your employees that put the calculator together. Okay? So direct labor, these are the people responsible for making your product. Call them direct labor. And the other one's called manufacturing overhead. Manufacturing overhead is how we allocate factory overhead to making the product. Here's what I mean by this. Manufacturing overhead involves all the other things, all the other costs associated with making the product. This manufacturing overhead includes things like indirect materials. Indirect materials are small amounts of materials that I use in the manufacturing process that I cannot track. For example, I make my calculator, I need to have a little bit of glue, okay, for the buttons. A little bit of glue. That amount of glue is so small, I can barely track it. So therefore, it is a part of what we call indirect materials. Indirect materials are part of manufacturing overhead. Other things that included in manufacturing overhead also include the supervisor's salary. The supervisor's salary, as I had mentioned, cannot be directly traced to the manufacturing of a single product. It can be included in manufacturing overhead because the supervisor oversees the production process but is not directly involved in the production process. Therefore, the supervisor's salary is a part of manufacturing overhead. Utilities is a part of manufacturing overhead. The rent is a part of manufacturing overhead. Manufacturing overhead, again, is kind of like everything else that's indirectly involved in the production process. And the way manufacturing overhead gets applied to the cost of a product is we take the total manufacturing overhead and we divide that by the number of products. We'll talk about this more later on, but I just wanted to give you an idea of what manufacturing overhead is. Direct labor, direct materials, and manufacturing overhead, we add these three costs together to equal the total cost of a product. Okay. In addition to the cost of the product, there are other costs that we have. We call these period costs. Period costs are the expenses that we cannot attach to the product. They're not directly a part of the product. We call these period costs. Period costs are the selling and administrative expenses. Selling and administrative expenses are period costs. Selling costs, this is the cost it takes us to get the finished good to the customer. A finished good is a product that's available for sale. Yeah, we call that a finished good. This calculator, it's finished. I can now sell it. It is a finished good. I can deliver that to my customer when they buy the calculator. The cost of getting the calculator to my customer is a part of selling costs. Delivery expense, yeah? Shipping expense. It's a part of selling costs. We also have administrative costs. These are the costs for non-manufacturing individuals. Administrative costs include the salaries for the office staff, the accountants, human resources, the office staff, yeah? Administrative costs. They support the business. Their support's not directly tied to the cost of a product, so we call them period costs. So period costs include selling and administrative expenses. So, period costs, selling and administrative expenses, are allocated to your income statement as operating expenses. Period costs are selling and administrative expenses that are simply allocated to your income statement as operating expenses. We have product costs, which are direct materials, direct labor, and factory overhead. Those are product costs. These three costs together equal the total cost of a product. I sell the product, take it out of inventory, finished goods, and it becomes what we call cost of goods sold. On your income statement, you have revenue, sales, sales, minus cost of goods sold. Cost of goods sold, they represent the cost, direct materials, direct labor, factory overhead, of the product that we sold. That's why we call it cost of goods sold. So when I sell my finished good, it becomes cost of goods sold on my income statement. And I did not yet sell it. If I made the calculator, okay, I've manufactured my calculator. I have not yet sold it. It lives on my balance sheet. Remember what's on the balance sheet? We got assets, liabilities, and equity, right? Under assets, we have cash, accounts receivable, inventory, and property, plant, and equipment. Yep, those are the assets. Within inventory, a manufacturing company has three different types of inventory. They have raw materials, work in process, and finished goods. Raw materials inventory are the materials that we use to create the finished product. In my calculator example, my raw materials are plastic and electronic components. Plastic and electronic components are my raw materials. I purchase my raw materials from my vendors. I purchase plastic from one vendor, and I purchase electronic components from another vendor. They deliver the plastic and electronic components to me, the company, and I store them somewhere until I'm ready to make my calculators. We call those raw materials. Raw materials, we have not yet touched them. Okay? My plastic and my electronic components that I have not yet used, we call them raw materials. They are part of my inventory. When I start to manufacture my calculators, I take the raw materials and I put them on the assembly line. Once the raw materials come out of my raw materials inventory, I put them into what we call work in process. Work in process. When the calculator is not yet done, my employees are putting together the calculator. Okay? They're assembling it. When the calculator is being assembled, the inventory is called work in process. Work in process. It's in process of being created. Work in process. At the end of the assembly line, after my employees have put together the calculator, it comes out of work in process and it becomes what we call finished goods. Finished goods is when the product has been assembled and is available for sale. Finished goods is when the product has been assembled and is available for sale. So it's important that you remember those three categories of inventory. Raw materials, these are the materials used to create a product that have not yet been used. Work in process is the inventory that is in process of being created. And a finished good It is the finished product that is available for sale. Yeah, go ahead. Yeah.
I was just gonna ask you, can you give another example again for the raw materials?
Sure. Yeah, I'll give you another example. Let's say that our company manufactures cars. Okay, we
Mm-hmm.
manufacture cars. I love this example. So for cars, in order to make a car, I need steel, I need aluminum, I need electronic components, I need some glass, and I need some rubber to make a car. Okay, so what I do is on the manufacturer, I make the cars. I call my distributors and I say, I need steel, I need aluminum, I need components, rubber, and glass. When I receive my order from my distributors, I put them into what I call raw materials inventory. Raw materials inventory is the inventory that I have that I'm going to use in the manufacturing process. Okay, raw steel, raw aluminum, raw glass, raw rubber, raw components. Yeah, haven't touched them yet. That's what we call raw materials. Then I start making the cars. Okay, so I have an assembly line. Yeah, think of an assembly line. At the beginning of the assembly line, that's where all your raw materials are. Okay, and then the car gets assembled in steps, right? We build the car in steps. The first thing we do is build the frame. So we use some steel to build the frame of the car. So the way it works is I take the steel out of raw materials and I put it into work in process when I start making the frame of the car. And then I take out some aluminum because at the second step, I'm going to start shaping the body of the car. Then at the third step, I'm going to take out some rubber and glass. I'm going to put the tires and the windshield on. It's, at this point, it's all work in process. When the car is in the process of being assembled, we call that work in process. We're taking the raw materials out of the yard and we're putting it into the assembly line, work in process. When we get to the end of the assembly line, the car's done. Okay, I got the wheels on, I got the windshield, I got the body's made, the frame is all together, I put the engine in. I'm getting ready to roll it off the assembly line. I take it out of work in process and I put it into finished goods. Good example? Makes sense?
Yes, thank
Awesome.
you.
Cool, very cool. Yeah, you're welcome. My pleasure. So, it's important that we understand the differences of cost. Earlier, we talked about fixed and variable cost. We talked about direct and indirect costs. And we talked about whether it's a product cost or a period cost. This cute graph here shows us the differences, yeah? So in this example, this company makes bicycles, yeah? They have bicycle tires and wheels as the first cost item. These are variable costs. The reason why they're variable costs is because the cost changes based on the level of output. The more bicycles I make, the higher the cost for my wheels and tires. These are direct costs. The reason why it's a direct cost is because it makes up a large amount of the cost of the bicycle, and it's directly tied to making a bicycle. And it's a product cost. It's a product cost because it's a part of the bicycle. Wages of the assembly worker. These are the hourly employees. It's a variable cost. The reason why it's a variable cost is because these are the employees working on making the bicycle, and the number of hours that they work varies based on the manufacturing of the bicycle. Yeah. Some bicycles might require 2 hours, some might require 1 hour, etc. Yeah, it's variable. It's a direct cost because these are the employees assembling the bicycle. They're directly tied to making the bicycle. That's a part of the product cost because they're directly responsible for making the bike. Advertising. Advertising cost is a fixed cost. The reason why it's fixed is because if I run one television ad, I only pay for that one television ad. Okay, whatever the cost is, it's fixed. Yeah. An indirect cost because I cannot tie a television ad to a bicycle direct and the manufacturing of it. And it's a period cost because, again, it's not a part of the product. Production manager's salary. This is the supervisor's salary. It's a fixed cost. This person gets paid the same no matter what. It's an indirect cost because the manager oversees the entire operation. It's not directly involved in making the bicycle. It's a part of the product cost. We typically put manager's salary into factory overhead. You can see how this works though, right? All of these costs are either fixed or variable, direct or indirect, product or period. Yeah, go ahead.
Yeah, that's a good question. I just so when we are, I guess, processing information about products or salary or any of these things, we do we kind of start from the product perspective?
Yeah, always. Yeah,
Always,
definitely.
okay.
So think about the product. Think about what goes into the product. If it's a variable costs are always typically product related. Okay, direct materials, direct labor, factory overhead. Anytime there's one of these three things are involved, it's a product cost. Direct materials, direct labor, factory overhead. These are all product costs. They are the cost to make a product. Yeah. So that's the best way to think about it. A manager's salary, yeah, it's a product cost because it's a part of the factory overhead. It's not direct, it's indirect because the manager's not the one making the product. See what I'm saying? So anytime you hear direct materials, direct labor, or something that's a part of factory overhead, it's a product cost. The period costs are selling and administrative expenses. Period costs are selling and administrative expenses. That's the best way to think about it. Great question, Asia.
Okay, thanks.
You're welcome. Now, we're going to keep talking about manufacturing companies throughout this course, but I do want to put cost in relation to other types of companies, just so you have an understanding of how those costs work.
Do you mind flipping back for one more second?
Yeah, of course, Tia.
Thank you. You could go and change it again.
Okay, you're welcome. So I want you to understand costs yes, obviously for manufacturing, because that's what we're going to be talking about for the next 7 weeks. But I want you to also understand what it looks like for a service company. A service company is a company that provides a service, right? An example would be an airline, an accountant, a lawyer, a dentist, a tailor.
Gym.
Was that Nick?
I would say like a gym, a massage therapist is a
Gym.
service. Massage
Yeah,
therapist,
gym,
places therapist,
massage.
yeah.
Yeah, exactly. Yeah, those are services. A lawn service. Uh, whatever. I can keep going. Service companies provide a service. They don't provide a product. Okay. So a service company, their costs are going to be organized a little differently. Because remember, there's no product. So we classify their costs differently. A lot of a service company's costs are typically variable. The reason for that is because it's based on the number of customers. Yeah? For example, in an airline, when they provide beverages and snacks on the airline, when you're flying, they come down the aisle with the little cart with the beverages and snacks. Those are variable costs. It's based on the number of passengers. The same could be said, we'll say, a gym. With a gym, the costs are variable. It's based on the number of guests at the gym. Okay? Based on the number of gym members. Yep. So, for example, at a gym, you have hourly employees, you have utilities, you have the machinery, the workout machinery. You've got the weights, you got the whatever else. All these things at the gym. Costs are variable. It depends on the number of guests at the gym. Yeah? It's a service business. They don't sell a product, they sell a service. So the point I'm getting at is costs are organized differently for service companies than they are for retailers or manufacturers. In manufacturing, there are three costs that go into making a product: direct materials, direct labor, and factory overhead. This graphic gives you a representation of the cost breakdown. 45% of the cost of making a product come from direct materials. 15% of the cost of making a product come from direct labor, and 40% come from factory overhead. This is pretty typical. It's not always this way. It might be a few percentages different, but it gives you an idea of what it normally looks like. So direct materials, again, are materials that we use directly in the manufacturing process. If I'm making a vehicle, a car, we'll say, I'm going to use steel, aluminum, glass, rubber, and components. Yeah. These 5 raw materials are used in the manufacturing process. We call these direct materials. I can directly trace the cost of these 5 raw materials to the manufacturing process. Yeah. We call these direct materials. They make up the majority of the cost of manufacturing the product. Direct materials. Direct labor. These are the employees' wages that I can directly trace to the manufacturing process. These would be the hourly employees that are assembling the car as it works its way down the assembly line. Hourly employees that are touching the car, hands-on employees, they're making the car. That's direct labor. They are directly involved in the manufacturing process. Factory overhead. Factory overhead is all the other stuff that I cannot directly trace, but they're related to the manufacturing process. Factory overhead are the costs I cannot directly trace, but they are related to the manufacturing process of a car. Yeah. Examples would be indirect labor, indirect materials, utilities, rent, supervisor's salary. They're involved. Those costs are involved in the manufacturing process, but indirectly. I cannot trace them to the manufacturing of the car. So the way I apply factory overhead is the way it typically works is I add up all my factory overhead together and I divide it by the number of units produced. In my example, the number of cars I've manufactured. It's one way. There's a lot of different ways to do it, and we'll talk about that soon. So you know, there's direct materials, direct labor, and factory overhead. These are the three costs associated with manufacturing a product. Direct materials and direct labor are oftentimes called prime costs. Prime costs. Direct material and direct labor together, we call these prime cost. The reason why prime cost is primary cost. Direct materials and direct labor are the primary costs to manufacturing a product, you see. That's why we call prime cost. Direct labor and manufacturing overhead together, we call these conversion costs. Let me explain why. We see that direct labor is both a prime cost and a conversion cost. The reason for this is that the labor that is directly involved in the manufacturing process can be converted based on the number of units produced. Manufacturing overhead and direct labor are what we call conversion costs because the cost can be converted based on the number of units produced. We'll dive a little bit deeper into this. Non-manufacturing costs, which are involved indirectly, are costs that are recorded on the income statement as expenses. Non-manufacturing costs. These will be things like selling and administrative expenses. They're not a part of factory overhead because they're not a part of the manufacturing process. Okay? Selling and administrative expenses are just expenses. And so because they're just expenses, they're period costs and they're recorded on the income statement as expenses. So let's talk a little bit more about inventory. Inventory for a manufacturing company includes raw materials, work in process, and finished goods inventories. Raw materials inventory, these are the raw materials these are the raw materials I have not yet used in the manufacturing process. The steel, the aluminum, the rubber, the glass, the components to make a car, they're not in use to make the car yet, we call those raw materials. Raw steel, raw aluminum, raw glass, raw rubber, raw components. Not yet being used. We call this raw materials. The auto manufacturer purchases the raw materials from their distributors. Okay? They get delivered to the car making facility, the warehouse, and they become raw materials. When we start to use the raw materials in the manufacturing process, we call that work in process inventory. I take it out of raw materials and I put it into work in process. I'm starting to shape the car, right? The frame, the body, the engine, the wheels, the glass, It's work in process. It's on the assembly line, work in process. When the car rolls off the assembly line, it's done and it's ready for sale. We call it finished goods. Finished goods, it's done. I can sell it now. It's part of finished goods. So that's the three types of inventory for manufacturing. For retailing or a merchandiser, we call these merchandiser. It's a retailer, same thing. They buy the finished goods and then sell those finished goods. For example, Amazon, Macy's, the grocery store, whatever. They sell finished goods. They're not going to sell you half an apple at the grocery store. Okay, they'll sell you the whole apple. These are merchandisers. They sell you finished goods. They buy them from somewhere else and then they sell them to you. So if you go to Macy's and you're looking for a new shirt, new blouse, okay? You're at the Macy's, you're looking for one. That's a finished good that you're going to buy. Macy's bought it from their distributor as a finished good, and now they're selling it to you as a finished good. That's what a merchandiser does. So on the balance sheet for a merchandiser or retailer, you'll see one part of inventory that's called finished goods. So for a manufacturer, again, raw materials. These are the materials that we purchased. They have not yet processed. They're waiting to go into work in process. Okay? And these are direct materials, sometimes indirect, depends. Work in process inventory. This is when we're making the product. We took it out of raw materials, we put it into work in process, it's on the assembly line, or it's in process. Yep. We call these partially completed units. Partially completed units when it's in work in process. It's partially done. The car, it's not yet done. I got the wheels on it. I didn't put the windshield in yet. I got the frame is done. The body is done. I got the wheels on it. Haven't put the glass on yet. It's work in process, and it's partially completed. Partially complete. When it's done, when I put the windshield on it and paint it and all that jazz, then it becomes a finished good. When it's finished goods, it's available for sale. This slide shows you the differences between the three types of businesses. You have service companies. These are your airlines, your barber shops, your accountant, your lawyer, people that mow your lawn, the gym. Yeah, these are service companies. Your Walt Disney, your Netflix, your Hulu's, your whatevers. Those are service companies. Yeah. Provide a service. And on the left side, you see that's what their balance sheet looks like. They don't have inventory. They're providing a service. They don't have inventory. They're not selling you a product. They're selling you a service. You don't physically touch the video, the streaming video. You watch it. You don't. You're consuming it. You're not. You don't physically have it in your hand. It's not inventory. So those are service companies. In the middle, we have our merchandisers, our retailers, our Amazon, our Macy's, our Walmart, or whatever's. These are retailers, also known as merchandisers. And they have inventory, and it's just called merchandise inventory. That's it. So when you look at their balance sheet, it'll say merchandise inventory. That's how much inventory they have on hand. Yep. And then on the right side, we see the manufacturer. We've got raw materials, work in process, finished goods. These are the three types of inventory for a manufacturing company. Again, in this course, we're going to be focusing a lot on manufacturing. When we sell a product, it comes out of our finished goods or our merchandise, and it becomes cost of goods sold. You got to take it out of your inventory if you sold it. You no longer have it in your possession. So we take it out of our inventory. When you take it out of your inventory, it comes off of your balance sheet and it goes onto your income statement as what we call cost of goods sold. For a retailer or a merchandise business, we take beginning balance inventory plus cost of goods purchased minus ending inventory equals cost of goods sold. Audrey. Okay? All right. For a manufacturer, we take the beginning balance finished goods inventory plus cost of goods manufactured. Here's what this means. Cost of goods manufactured, simply that. It's the raw material, direct materials, direct labor, and factory overhead that we used to create finished goods during the accounting period. So beginning balance plus cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. So this kind of shows you side by side what each one of those looks like. And here it is again, nice visual representation. For merchandiser, we have beginning balance plus cost of goods purchased equals cost of goods available for sale minus ending inventory equals cost of goods sold. For a merchandiser, beginning balance plus cost of goods manufactured equals cost of goods available for sale minus finished goods ending balance finished goods equals cost of goods sold. Just a visual representation of it. When we think about costs in manufacturing, I want you to really think about the assembly line in your mind. Okay? Think about an assembly line, how cars manufactured. We have our raw materials over there. Okay? Purchase raw materials I receive my raw materials. And then I start to use them. I take it out of raw materials, put it into work in process. Now I can start making my car. As I'm making the car, I have the raw materials that I'm using. We call those direct materials. Direct materials that I'm using, plus the labor that's involved in the manufacturing process, plus the factory overhead that's involved in the manufacturing process. Direct materials, direct labor, factory overhead. As it's moving down the assembly line, I'm adding in more and more and more throughout the process, right? Think about the assembly line. It starts way over there. Raw materials. We take the raw materials out, we put it into work in process. As the car moves down the assembly line, I put together the frame, I put together the body, I put the engine in, I put the wheels and the windshield on. Each step in that manufacturing process, I'm adding more direct materials, more direct labor, and more factory overhead at each step. Step number one, we're putting the frame together. So I got my steel, that's direct materials. I got the people doing it, direct labor. And I got factory overhead, the machines. As it moves down to the next step, I'm putting the frame together, the body together. I got aluminum, more direct materials. I got the people doing it, more direct labor. And I got more factory overhead, more machine. But you see, we're adding more and more and more as it goes through the work in process. When it's done, it becomes finished goods. Yeah, it's ready and available for sale. That's how it flows. I want you to think of the physical flow. Yeah? The costs are flowing as the product gets manufactured. To the physical flow. Here's the formula to find cost of goods manufactured. This shows us the summary of the manufacturing process. Starts with direct materials, right? Direct materials used plus direct labor plus factory overhead equals the total manufacturing cost. That makes sense. Direct materials plus direct labor plus factory overhead is manufacturing cost. Plus beginning work in process. What did I start the month with in work in process inventory? Minus ending work in process. What I end the month with equals cost of goods manufactured for that month in the accounting. For my income statement, well, we call this a manufacturing statement. A manufacturing statement is an internal managerial report we use to provide the manager with a snapshot of information. We look at our direct materials, our direct labor, our factory overhead to equal our cost of goods manufactured, right? Materials plus direct labor plus factory overhead equals total manufacturing cost plus beginning balance equals cost of work in process minus ending balance equals cost of goods manufactured. Call this a manufacturing statement, and it provides the manager with information on the total cost of goods manufactured during the accounting period. Since this is a managerial accounting course, we talk about these types of information help managers to make decisions. Direct materials plus direct labor plus factory overhead equals cost of goods manufactured. Should look somewhat familiar. We know that we start with the income statement. Income statement has sales minus cost of goods sold equals gross profit minus expenses equals net income. Cost of goods sold represent a portion of the cost of goods manufactured. They represent finished goods inventory. So this kind of shows you how the income statement, balance sheet, and the cost of goods manufactured are all related. Accounting, in managerial accounting specifically, we focus on the business. How do we make the business better? Right? As accountants, we look at cost, we look at sales, we look at cost, we look at the operation of the business, and we think, how can we make the business better? So we focus on customers, the global economy, services, internet sales, the value chain, and this concept called lean practices. Lean practices simply means we try to eliminate waste from the business to make the business more efficient. Focusing on our customer at the center of everything our business does is a great way to grow your business because we're continuously improving based on our customer's experience and what our customer wants. We can continuously improve this way. That's what we do in business. We continue to improve. We look at ways to eliminate waste. We try to emphasize the value our customer is looking for. We look at ways to improve our business activities to make ourselves more lean. And we look at new methods to improve the overall quality of our products. In manufacturing, there's a Japanese system of manufacturing. And we call this just-in-time manufacturing. The reason why I say it's Japanese is because it was invented by a couple of Japanese companies. And the way it works is the customer orders the product directly from the manufacturer. I want you to think of it like a Tesla or let's say it's a special car that you want to buy. Yeah, a special, something unique. Something unique you want to buy, like a new custom pair of Air Jordans, or something unique. They only make one, and it's for you. So you special order Etsy, Etsy. Let's say you order something. You want it customized for you. So you place the order. When you place the order, it goes into the production schedule. The manufacturer purchases the raw materials that they need to make the product that you ordered. Then they start making the product that you ordered. That goes into the assembly process, then it becomes complete, and then they ship it to you. We call this just-in-time manufacturing. They don't manufacture the product before you buy it. You order it, then they make it, then you buy it. Yeah. They'll call it just in time. There's no waste. There's not a whole lot of inventory sitting there of the same thing. That's why we call it just in time. Value chain represents a process. Think of a bakery, for example. Bakery is kind of a service. It's not necessarily a retailer. I think they're more of a service than a retailer, if you will. I guess you can consider them retail. It depends. It's debatable. So think about it. A bakery. They have eggs, sugar, flour, and some, what do you call oil. They bake the bread, then they sell the bread to you, and they provide the service. This is what they call value chain. There's value added at every step of the process. In manufacturing, it's important that we're lean, meaning we don't waste. We adapt to changing information. It means to be lean. Businesses are, especially now, becoming more responsible to society. Corporate social responsibility is where they focus more than just profit. They focus on social and environmental impacts. Of course, it wouldn't be a lesson without a couple of ratios. This one's called the raw materials inventory turnover. It tells us, the company, how efficient we're using our raw materials, how quickly we're using our raw materials. The formula is raw materials used divided by average materials inventory. Materials used divided by average materials inventory. I had mentioned last week, when you see the word average, it's the beginning balance plus the ending balance divided by 2. And another one is called day sales and raw materials inventory. Shows us the efficiency, how quickly we're turning it over, the raw materials. Raw materials inventory divided by raw materials used times 365 days. Any comments, questions, or concerns about manufacturing so far? Cost. Okay. Okay, let's take a short break. I'm going to stop the recording here.